business did very well. I mean, makes my life a lot easier. Okay, so I want to take you guys through the 6-month results. I'll also spend a fair bit of time on the buyback program, because that's obviously quite a big part of the announcement today. So we'll have a few more slides than usual on the capital management thinking. We'll start with the usual slide. We always have this as our first slide in the financial section. Now, I told Hilly it's not to flatter ourselves. We would have chosen other slide otherwise. But these are the 3 key financial metrics we measure ourselves by. And in fact, these drive about 2/3 of our balanced scorecard and our incentive pools at MMI Group. So these are really critical metrics, and they haven't changed for a while now. Now, I'm going to start on the bottom left, which is value of new business. Basically flat year on year. But I must say it's a bit of a relief, because the first quarter was quite difficult. So we've seen significant improvement in the second quarter. Now, a lot of people won't know, but in July, we changed quite significantly the way we service the IFA and the agent channels. Previously, we didn't have a very differentiated model between those 2 channels. In July, that differentiated model was sort of instituted, and it does mean July was an extremely weak month. So we've been playing catch-up since then. Looking at the sales since then and into the new year, it does look like it was really the right thing to do. So the sales performance is improving. The embedded value, return on embedded value, 11.2%. I would call it satisfactory. Obviously, markets were very favorable. At the same time, I think it's important to realize that we are making significant investments into India and lately into the African Bank joint venture. Now, those investments we carry at cost until such time that they become profitable and we can put a real embedded value on it. So no matter how excited we are about India, it is going to be a drag on our ROEV until the business matures. The last number I'll talk about is core earnings. Now, they're down 3% for the 6 months, approximately 40 million decline. I would go and defend this number to say the 1.6 billion in this period is a lot better than the 1.6 in the previous year. The reason simply being that we invested 200 million more after tax in growth initiatives like India and IO, the mobile Africa thing. And also we spent a lot of money on improving the wealth platform, launched the retail app, we improved the personal financial management tools, we got a new online store in Multiply, the African Bank JV had some startup costs. So the 1.6 billion was produced by a business that I think is in a much better state than 12 months ago, and one that has a lot better growth prospects going forward. Okay, this slide sort of jumps into the big news of the day on the financial front, and it is the capital distribution. So we have decided to buy back 2 billion rands of our own shares and not pay a cash dividend during the period. Now, the first point to make here is we are lowering the payout ratio now and going forward. So we're not trying to hide away from the fact that in light of our investment profile into the growth initiatives and the new SAM regime, we have come to the conclusion that we need to change the dividend policy, and we will be targeting a 40% payout ratio in the future, compared to about 60%. That was our sort of planning under the prior regime. The second thing is that we will do a repurchase, as I mentioned earlier, the 2 billion. And the reason for that is that we continuously trade, well, perennially trade at quite a deep discount to embedded value. We do believe in our embedded value of 27 Rand, and we think it's better for shareholder value to buy back stock rather than pay a cash dividend at this point in time. I'll show later that we estimate that there will be approximately a 30 cents per share, EV per share uplift from this process. The next question is why now? I think the reality is that the SAM specifications have continuously been tweaked, sort of heading towards the implementation date, which is 1 July this year. And it's only in the last couple of, let's say, 6 months that we really feel that the technical specifications are bedded down. Coinciding with that, we did a massive project over the last 6 months to look at our capital modeling and then optimization under the new regime. So we are a lot firmer in our sort of projected view of our capital needs going forward. So I think already last year we did tell people that the dividend might not be sustainable, and really the depth of work we've done sort of shows that also mathematically. In terms of why now for the repurchase, obviously the discount to EV is quite wide. This is probably the most detail we showed on the SAM balance sheet projections to date. Now, I did leave out the scale out. We'll put that in from the 1st of July when it becomes official. But there's 2 quite important stories on this one highly simplified slide. The first one is our capital position has improved a lot in the last 6 months and will continue to improve in the next 6 months. Now, the big project we've done, we have implemented a number of interventions to strengthen our balance sheet. One of them is that we have reinsured certain tail risks that we think are overly penal under SAM. So effectively, we can reinsure to international reinsurers at a minimal cost compared to the capital we save. We have also relooked at the way we manage certain products. So some of the products have a more onerous asset liability mismatch capital component under SAM than under the old regime. So we have relooked at the way we manage those products, basically the level of mismatch risk we're prepared to carry. Some of the stuff is really simple as well, like let's not leave cash sitting in SPVs that get treated as equity. Okay, so some of it's been administrative. And I suppose the last example I'll give you is that we have improved the way we model, for example, the way deferred tax assets react in downward scenarios. So a lot of it is actually just refinement of modeling and making sure we get all the diversification benefits possible. Okay, the second story on this slide is really the slope of the graph going forward. So at the moment, we're operating, in fact, above our upper end of our target range on the new SAM regime. At the same time, the red line shows that under our old policy, that ratio is steadily declining. So we could have kept the dividend flat, maybe another 5 years, 6 years, 7 years, but eventually we will be migrating towards the low end of that range. Effectively, the old dividend policy was inconsistent with the capital requirements under SAM. Now, without getting too technical, I suppose a big part of it is that SAM is a bit more penal on our new initiatives than the old regime. Also, the old CAR measure was quite dominated by the investment resilience test that comes out of Smith bonus business, which is running off, whereas SAM is a lot more holistic the way it looks at the risks in the business. So the capital runoff is less favorable under SAM. Then what we did is that we said, okay, obviously we'll rather take action now than hope for the best. So we backwards solved what is the right dividend policy to keep that capital ratio basically level going forward. And the answer is the 40% I mentioned earlier. Now, obviously we will review this from time to time. But for the time being, our best estimate is that a payout ratio of 40% will result in a stable capital coverage. Also note that we are a little bit above the upper end. That also means being able to do this glide path where the buyback program is actually a little bit bigger than if we sort of strictly just use the 2.5 cover. So there's a little bit of a top-up in that buyback program from the current surplus position. When we were preparing for this, we had massive internal debate. One of the questions was, will people read something negative with this buyback program into our financial strength? And I want to make it 100% clear that our balance sheet is probably as strong as it's ever been, as shown in the previous slide. Just in December, our AAA financial strength rating, which is obviously the highest you can get, was affirmed by the credit rating agencies. If anything, from a policyholder and intermediary perspective, the new dividend policy improves the balance sheet going forward. So it really should be seen as a positive in terms of financial strength, rather than any type of, let's call it a reactive decision by us. Okay, then looking at the program itself, some of the key points. Now, the board has approved that we will buy back 2 billion rands of shares. Looking at the daily traded volumes and the amount of shares that we want to participate in per day, it will take most of this year to complete this program. We also decided to make it an open market purchase, so shareholders can participate if they wish, and they can keep their shares if they wish. So instead of a scheme of arrangement that will force everybody to sell, we will make it elective for the shareholders. We have instructed our agent who's buying shares for us that they can go up to maximum of embedded value per share. Because obviously mathematically the value creation sort of stops once the stock is trading at fair value if you take embedded value to be that. Depending on what happens with the share price, we estimate we'll end up buying about 5 to 6% of the shares in issue. And we have had a few questions this morning. Yes, we plan to cancel those shares, so we will not hold them for reissue. So they will be cancelled on a regular basis. Okay, this slide is an award winner. In group finance, we spent quite a bit of time thinking, how do we illustrate something this complex in one slide? And this sort of design won the award. Now, effectively, we believe our embedded value is 27 Rand. Otherwise, we wouldn't publish it if we didn't believe it. Now, the share prices are at 21 Rand, 22 Rand. So we're effectively getting 5 Rand extra EV for every share that we buy back. Now, you do that across 90 million shares, roughly. We can buy 2.5 billion Rand of EV for 2 billion of cash. So it's quite an easy 500 million value add from an embedded value perspective, Once you divide the 500 million over the remaining 1.5 billion shares, you get an uplift of about 30 cents per share. Okay. There is a more detailed slide that came second in the appendix. Okay. Let's go now to the more vanilla results type of presentation material. So this is our earnings waterfall year on year. So earnings are down 3%, core headline earnings, 42 million rand. Now this illustrates quite nicely that 228 million, that is the additional investment into India, which must have been alone about 60, 70 million, into IO, into money management, into technology, into distribution related matters. So to keep earnings relatively flat while investing what looks like about, 15% extra is quite an achievement. In terms of the more business as usual items, life underwriting recovered significantly. Most of that is actually in the group business as corporate business, as Tina mentioned earlier. Short-term underwriting, that's both guard risk and MSTI. In general, guard risk did very well. Significant growth in earnings there. The one item that is a bit disappointing is persistency. This mainly stems from the metropolitan retail business, the lower income market segment. We are seeing premium collections being under pressure there. Now, let's not get too excited, but second quarter was better than first quarter. Also, there is significant interventions taking place in terms of quality of recruits, the role of the branch manager, technology we actually enable the salesman with, and so on. So we're certainly not just waiting for the economy to recover, we're taking quite significant action. Investment returns, we stabilize a lot of the investment market impact on our earnings. It's part of our accounting policies. There was still a benefit of 100-odd million, which relates really to the asset-based fees we earn in different parts of our operations. Also important to note that we had a very good credit experience for the 6 months. So obviously there was quite a large company that had credit-related events, and we avoided exposure to that, so we're taking zero loss there. Reduction in reserve releases is a technical item, and this relates to a lot of legacy business we have bought over the years, even before MMI, in the momentum days. There's a lot of, let's call them, discretionary provisions or margins sitting on these old ring-fenced books, and they're running down over time. The only positive maybe to mention here is that the absolute number is becoming quite small. So the year-on-year impact on our earnings growth will be moderating going forward. Okay, this gives a little bit more detail in terms of the divisional results. Maybe to highlight first the 11% growth on the line called operating divisions. That is the operating profit growth before the 3 largest initiatives that we ran during the period. That's probably the most representative number in terms of underlying growth in our core operations. Corporate had a fantastic 6 months. So it's a very diverse business, and it is the first time I can remember that underwriting was good, short-term was good, health was good, investments was good, expense control was good. So it's really got a very diverse business, everything pointing in the right direction, and that resulted in a more than a 40% increase in earnings. Momentum Retail, the 8%, I wouldn't be too worried about. A lot of the new initiatives I spoke about earlier, those really relate to the Momentum Retail business. We also took a 43 million after-tax hit on earnings from reviewing our reinsurance payments and receivables for the last 5 years. So there's a one-off adjustment in there as well. So I think, again, the business as usual performance is better than that. Metropolitan Retail is probably the more disappointing of the 2 retail operations. So that 15% is less affected by one-offs. The persistency variance, as I mentioned earlier, remains difficult. About a 40 million decline of earnings is because of, let's call it, premium collections or persistency. Also, there is a base effect here that we had very good 6 months again in terms of the mortality experience on our funeral book, but it was only 1 million rand higher than last year. So it is difficult to make more money when you're coming off a very good year last year. International, that number is flattered a little bit by exit of some loss-making countries, but within there is a good improvement in Namibia. So Namibia often shows similar dynamics to South Africa, and last year we had high disability claims in Namibia, which didn't repeat this year, so very similar to some of the things Tinus was speaking about. And then we do have our UK asset management business in there, which had a better 6 months. Okay, talking about, this is actually volume of new business. I see the title is value. 5% decline in overall sales. The retail operations, the 3% growth in MOM Retail and the 9% in Met, I actually think that's not bad if I look at some of the recent results. And also, the fact that we were at 0 through the first 3 months. So again, this is where we felt that very difficult July, and we've been playing catch-up since then. In Momentum Retail, I would say the three biggest stories around sales is we had better offshore endowment sales, so that talks to that improvement in the platform functionality that we achieved. Also, our guaranteed endowment product has sold very well. Hilly already mentioned that. And then lastly, Myriad, which is our core risk product. That continues to do quite well. So we had 8% growth in Myriad, which again, I think compares quite favorably. Metropolitan Retail, 9% growth. The core funeral book sales growth was about 4-5%. We had an unusually good 6 months in single premiums in this business. Often in the low end of the market, single premiums are not that, let's say, stable from period to period. And we had some very good flows in the preservation funds. Maybe the 5% is more realistic in terms of the underlying growth trend. Momentum Corporate, Tina's mentioned there's a big focus on profitability, which means that we actually, I wouldn't say walking away from business, but we're not very competitive on some of the quotes. Also related to the distribution, let's call it lack of distribution at one stage. We didn't win any large annuities or investment contracts. The one positive behind that negative 24 is the umbrella fund product, Funds at Work, continues to do very well. That's sort of a steady, every quarter sales are strong and it keeps growing. International is down slightly, but last year included 2 large EB schemes that we got in Lesotho, which went repeated. Then looking at value of new business, again, the margin ended up at 1.4 for the 6 months. It was 1.2 after the first quarter, so recovery in the second quarter, and again, a stable margin, I think, in the current environment wasn't a bad outcome. Metropolitan Retail margin is 4.5, which is actually very favorable compared to its sort of long-term history. And there the reason is simple operational gearing in that sales volumes went up by 9%, while the headcount in the sales force actually declined. So the productivity gains are coming through the operating the profit margin. Momentum Corporate flat VNB, but on much lower volumes. So it does show that the focus on profitability means that we can create the same amount of value on much less volumes by being very disciplined in terms of what business we accept and at what rates. Momentum Retail, that is a decline that we sort of went that surprised about, mainly because a lot of the initiatives I spoke about earlier, they relate to Mom Retail, and a lot of that spending ends up counting as part of our acquisition costs in the way we calculate the VNB. So that is the area where we sort of invested up front, and obviously we hope the volumes will follow and the margins will improve going into the second half of the year. Now, International was again affected by the non-recurrence of the 2 schemes that had good margins last year. Okay, this is a nice new slide on our EV per share. Just to remind people that 80% of our EV is our life business. And our life business, I think we can happily say we're competitive with anyone. The return on embedded value was 15.5% for the 6 months. It was aided by markets a little bit, but there's no doubt that we can continue to sort of exceed the cost of capital in our life business. If anything, we think we can further get some capital efficiencies and ROEV improvements. What has been hurting our ROEV for the past few years, and again this period, is that bit at the bottom, which is our non-life operations, which is about 20% of the business. The return on embedded value was negative during the time period. Obviously, we're not satisfied with that. Now, there is a technicality, like I mentioned in the beginning, about a lot of these startups generate 0 returns by definition. At the same time, we've been having to write down a lot of the initiatives that we are now exiting or toning down. So you could say that the current period still contains a bit of an overhang from strategic decisions a while back. Also, like Hilly, maybe to warn a bit on expectations, it will take a number of years before India becomes profitable. So it will be a number of years before we start fair valuing some of these new initiatives. It means that we're going to have the structural drag on the ROEV for some time. So if anything, I would expect the ROEV of the non-covered to remain below that of life insurance for a few more years. More traditional view of EV profits. I've already spoken about a lot of these items. I'll just maybe mention 1 or 2 things for the diehards. So the N1 of discount rate is a little bit lower this year. We made a decision last year to change from using a single point in the yield curve, which was the 10-year point, to do the discounting and the embedded value work. We now use the whole yield curve. So 1 year cash flows are discounted, 1 year rates, 2 years, and so on. That has a negative effect on the unwind line coming through here. It is compensated that the market impact line should be a little bit higher because the expected return is lower in year one. So if anybody really wants to talk about that, they can grab one of the actuaries later and ask for more. The experience variation line item here, it's negative, but I just want to point out that the actual variation was positive for the period again. Very strong mortality profits offset by some of the additional expenses. We did strengthen our assumption around the EB business at mid-year. So we generally don't do too many assumption changes at mid-year, but on EB we decided to increase the admin cost per scheme just a little bit in December. And it's pretty obvious that the biggest change from year to year on the EB profit is the market-driven line item there. Okay, I'll talk about capital management now. It's a bit shorter than normally because I already covered one or two items in the share buyback commentary. This is the excess capital position that we show every 6 months. Now, I just want to make a point that this is still under the old SVM/CAR regime. Internally, we're increasingly using the SAM world in terms of looking at our capital. And probably not at year end, but by this time next year, we will present the external numbers on that basis as well. The story is the same though. Our capital position did strengthen over the 6 months. So that's that increase from 3.7 billion to 4.1 billion. This really measures the capital in excess of our own internal target, economic target. Again, the life insurance operations were the two green bars. So we made 1.6 billion after tax statutory profit. Also, the required capital dropped by 500 million. And that reduction was really driven by the improved funding levels in our smooth bonus funds. Effectively, the guarantees are less likely to bite us. And then secondly, we improved the hedging around one or two of our non-profit risk products. So life insurance contributed sort of 2.1 billion extra to the available capital. The negative item here is non-covered required capital. So during the period, we injected quite a bit of money into new initiatives and also to recapitalize some of our existing non-life operations. We treat that capital as not available for shareholders for the primary reason that there are some fungibility restrictions in some countries. And then secondly, a lot of the capital is required to actually build and sustain those businesses. So we don't take any credit at the center for capital we have injected into non-life operations. Okay, this is a slide we have started to show the last few times. We are going through a significant period of investing, so it's fair enough to show shareholders what we're doing. I suppose it's pretty clear that African Bank joint venture, particularly on the lending side, and the Aditya Birla India JV are the two main items. So we are budgeting about 200 to 300 million rand per year as an ongoing capital injection into those initiatives. You'll see here that, for example, India is expected to start coming out of the J-curve, or the J-curve starts turning in about 2021. But this is a substantial percentage of our retained earnings, and which again talks back to the dividend policy a little bit and trying to get that balance right. For the current year, the next 6 months, there are two other items worth mentioning. In yellow there on guard risk, we're retaining 200 million at MMI Holdings, the center, just to see what the finality is around SAM specifications on cell captives. So that is just money set aside just in case. The blue bar represents lots of smaller transactions that pop up. So when we do the projecting, we don't really know. We know of the bigger things, but we don't know the small things. So at the moment, we've got quite a number of smaller transactions taking place. At the same time, also, we do have to provide capital support into a lot of the African countries, so that's all within the blue bar. Okay, so India, Aditya Birla is, well, it's by far the largest investment outside of South Africa. It will probably be the largest investment anywhere for the next 5-6 years. So it's only fair that we sort of give shareholders quite a detailed update on what's going on there. I think the short version is we couldn't be more pleased with how things have turned out in the last 15 months. The business really started only in November 2016. It's got 800,000 lives already. We have a wide countrywide presence by branches and agents, 13,000 agents. What is also very important and not obvious coming from South Africa, to tie up with 3,500 hospitals, the supply network, is not easy. India is a very fragmented healthcare market. There are hundreds of people or companies behind those hospitals. So to be able to actually integrate our systems, into all of them has been quite a major achievement. Also, the Multiply program has been launched there recently, and that's working very well. And the list of partners is quite impressive. In fact, there's some partners over in India I wouldn't mind having here. So operationally, this business has done, well, I would say it's even exceeded our expectations. And financially, it is meeting targets, which, having been involved in a few startups, just meeting targets is maybe not a bad outcome. Now, how is it possible? I think we have to give a lot of credit to Aditya Birla, our partner here. Now, a lot of people don't know them. They are the third largest conglomerate in India. In fact, the company through which they hold this is Aditya Birla Capital. It's listed. That's their financial services interests. Aditya Birla, they own controlling stakes in a lot of very well-known companies like Idea Cellular, Ultratech Cement, Hindalco Industries. I mean, this business partner is a substantial player in India and globally. I actually Googled a bit last night to make sure I don't talk any rubbish here, and I saw that they're number one producer of viscose fiber globally. Okay, and we're often happy just being number one in Centurion. So clearly the partner is in quite a different league. But like I'm saying, we just couldn't be more happy than the way this thing has been rolled out so far, and we remain extremely committed and excited about this joint venture. Okay, so Tinus had an award slide, so I want one as well. In finance, you don't often get any awards, but so on Aditya Birla, the point here is that the product has been extremely well received. Obviously, the growth numbers wouldn't have been possible otherwise, but it has won a number of awards as the best insurance product, best new insurance product, both in India and globally. And the product offering is actually very broad now as well. So we expect growth rates to remain very impressive. Okay, my last number slide, or group finance slide, talks about portfolio optimization or rationalization. So as Hilly alluded right in the beginning, we are trying to reduce how many things are going on. Just some progress. So Momentum Financial Technologies, this is the UK business that has been sold. We are also further looking at rationalizing some other smaller businesses that are tied to our UK presence. We have received offers for majority of the African countries we want to exit. Now, as you could guess, the due diligence and regulatory process can take a bit of time. So I think I'll tell shareholders not to expect finality even by financial year end, maybe calendar year end. But we are making steady progress to exit these countries in probably the fairest manner and financially the least painful manner that we can. Okay, now that brings the presentation, mine and the whole presentation, to an end. I did tell Hilly that normally the CEO comes and does some closing comments, but he was like, you know, what can an oak say after 15 days? So we'll get away with it this time. Next time you'll have to come and say something very deep and insightful. Yeah, so we'll open it for Q&A. Dan will moderate the questions and answers.
Thank you very much. Let's give Risto a round of applause for the presentation.